Hello everyone, welcome to Indonesian Student Channel. Today we will discuss on investment topic. But before we start it, I would like to introduce myself first. My name is Rahman Dika Dipradana. I'm from Indonesia and I'm currently studying in Malaysia at UCSI University in major of Business Administration. I have also studied at University of Applied Science Münster in Germany on same major for 2 semesters. Now, let's go to our lecture. In this lecture, I want to talk about investor and trader. Knowing the difference between investing and trading will determine how are people gonna believe and manage money. I've been relocating my money into stock and mutual fund since I decided to build my wealth and saving for my future. Therefore, I want to share those knowledges and experiences with you and hope it can help you. Maybe some people are still confused to decide whether they want to be an investor or a trader, as these both involve seeking profit in the stock market, but they pursue that goal in different ways. A stock investor is a person who commits capital with the expectations of receiving financial returns. They normally invest their money by purchasing stock shares of some chosen companies. On the other hand, a stock trader is a person who attempts to profit from the purchase and sale of stock shares. Stock traders can be professionals trading on behalf of a financial company or individual trading on behalf of themselves. Their primary goal is to purchase and sell shares in different companies and try to profit of short-term gains from stock price fluctuations for themselves. A stock investor is often held for a period of years or even decades. While market fluctuates, investors will ride out the downtrends with the expectation that prices will rebound and any losses eventually will be recovered. Stock traders jump in and out of stock within weeks, days, even minutes. They often focus on stock's technical factors rather than companies' long-term prospects. What matters to trader is the direction of the stock will move next and how the trader can profit from that move. Long-term stock investor focuses on the fundamentals. The majority of investors who want to evaluate long-term investment decisions start with a fundamental analysis of a company, an individual stock, or the market as a whole. Fundamental analysis is the process of measuring securities' intrinsic value by evaluating all aspects of a business or market. Tangible assets including land, equipment, or buildings that a company owns are reviewed in combination with intangible assets such as trademarks, patents, branding, or intellectual property. When evaluating the broader scope of the stock market, investors use fundamental analysis to review economic factors, including the overall strength of the company and specific industry sector conditions. Fundamental analysis results in a value assigned to the security in review that is compared to security's current price. Investors use the comparison to determine whether a long-term investment is worth buying because it is undervalued or if it's worth selling because it is overvalued. Whereas a stock trader focuses on technicals. Technicals analysis is a trading discipline to evaluate trading opportunities by analyzing statistical trends gathered from trading activity, such as price movement and volume. Unlike fundamental analysis, which attempts to evaluate securities value based on business results, such as sales and earnings, technical analysis focuses on the study of price and volume. Technical analysis tools are used to look over the ways supply and demand for a security that will affect changes in price, volume, and implied volatility. Technical analysis is often used to generate short-term trading signals from various charting tools, but can also help improve the evaluation of a security's strength or weakness relative to the broader market or one of its sectors. This information helps analysts improve the overall valuation estimate. Buy and hold is a strategy that means staying invested even when market look uncertain. It is used by stock investor. Buy and hold means committing to the chosen investment for the long term rather than buying and selling funds or stocks and shares frequently. It is a passive investment strategy in which an investor buys stocks and holds them for a long period regardless of fluctuations in the market. An investor who uses a buy and hold strategy actively selects investments but has no concern for short-term price movements and technical indicators. There is an expectation that successful long-term investing is all about time in the market and not timing the market, as it is so difficult to predict ups and downs, certainly with any regular degree of accuracy. Essentially, buy and hold is the opposite of trying to beat the market, which involves trading on a regular basis in the hope of staying ahead of the crowd. Buy low, sell high is possibly the most famous adage about making in the stock market, especially for stock trader. It is so obvious, it sounds like a joke. In reality, it is a lot easier said than. But low, sell high is a strategy where traders buy stocks at low price and sell them at a higher price. This strategy can be difficult as prices reflect emotion and psychology and are difficult to predict. Behind the truism is the tendency of the markets to overshoot on both the downside and the upside. Part of the reason is a pure herd instinct that drives stock prices. The investors who takes an unbiased look at the market might be able to see the herd instinct at work and take advantage of the extreme ups and downs that it causes. That investor can buy low and sell high. Unfortunately, it is easy to determine after the fact whether a price was too low or too high, and even why. During the moment, it is monumentally difficult. Prices both affect and reflect the psychology and emotions of market participants. For these reasons, buy low, sell high can be challenging to implement consistently. Traders trying for a more objective view consider other factors to make a more informed decision. These factors including moving averages, the business cycle, and consumer sentiment. A stock investor must be able to survive in a bear market. A bear market is when prices of shares fall sharply, and a sweeping negative view causes the sentiment to further itself. As investors anticipate losses in a bear market and selling continues, pessimism grows. When stocks begin to fall, it is hard to know when they will reach their bottom. If they wait too long and stock rises again, they have missed an opportunity to buy on a dip and won't profit from the rebound in prices. But if they are too quick to pull the trigger, they may see your new stock purchases continue to decline further. It can be tricky to identify the best timing in these cases and to manage active trading of a bear market. For the average investor, when the market is down, they will be buying more shares with that money. The more shares investors have, the greater the value increase when the market recovers. Investors can think of a bear market as a sale at their favorite store. When the items go down in price, they can buy more with the same amount of money as when they are full price. Hold on, don't panic, buy more is the mindset the stock investor should stick with. On the other hand, a protective stop is a strategy used by stock traders and designed to protect existing gains for further loss by means of a stop loss order or limit order. A protective stop is set to active at a certain price level and normally guarantees that an investor will make a predetermined profit or loss a predetermined amount. For example, if one buys a stock for $50 and wishes to limit loss to 10% or $5, one would simply set the protective to stop at $45. A protective stop offers trading discipline to investors by helping them make important decisions about cutting losses, but can also at times mitigate profitable opportunities. In other words, it can act as both a risk-averse strategy and a profit-averse nightmare. So, whether you decide to be a trader or an investor will depend on your financial needs and your approach to finance. Both methods bring returns provided you in act of disciplined manner. If you are new to share market investments, start on the right foot. It is good to start with investing in stock rather than trading for the beginner, as you can build your level of tolerance when you generate losses. Okay, to review this lecture, I want to give you some question. Feel free to pause the video and try to answer this question. So, thank you for watching this video. If you like this video, just to make sure to press like button. Please leave comment if you have further questions and don't forget to subscribe.